Thank you very much, Lisa. I appreciate that introduction exactly the way I wrote it up for you. So, and that book, trust me, I have like 1,000 of them in my basement. So you can, they're still on sale if you can find them. They're cheap. But so I will. I've known Mike a long time. Mike and I went to Georgetown together, and we both were on the baseball team. I think he actually played. I had a uniform, so that was about it. But it's a great pleasure to be here. I'm going to talk for maybe about 20 minutes tops. I'll try to do my best to keep you guys on time, and then we'll have maybe 10 minutes of questions if there are any questions. And I'm just going to talk about what I see for the economy and the markets, and try to answer some of the questions that I'm getting most when I'm on the road and I visit our clients or institutional investors. I'd also say, there's humility is an extremely, in my book, is one of the extremely important part of the markets. Generally speaking, unappreciated if you have to manage other people's money or make forecasts. But there was a famous economist by the name of John Kenneth Galbraith. He said there are two types of economists: those that don't know and those that don't know they don't know. And I am very much in the realm of I know I don't know, but I'm going to give you kind of what I think is the highest probability outcomes as far as the economy and the markets and monetary policy are concerned. So with that, I'd say kind of using as a shorthand for kind of the way I think about the world, it's a little bit like Sergio Leone. You might remember have these spaghetti westerns, and they had the good, the bad, and the ugly. And that's kind of the way I look at the market a little bit right now. And the good is the idea that I think even though there's a lot of hand-wringing and gnashing of teeth, I think the chances of a recession in the U.S. are quite low going into 2016. The other part of the good is that I think there's also been a lot of consternation about China. And I'd say that the chances of a hard landing in China are also quite low. And I'm going to explain to you a little bit why a little bit later. I'd say the bad, unfortunately, is that it's pretty difficult to, at least for the S&P 500, for the U.S. markets, I would argue it's pretty hard to argue that you're going to get big returns in the next year or two in the absence of multiple expansion. If you look at first call earnings right now, first call earnings for the S&P 500 are about $128. Those are the expectations for next year. If you put a 17 multiple on that, that tells you maybe you have 4 or 5%. And and a 17 multiple is, given where interest rates and inflation, it's not particularly high, but it's very difficult without broad retail participation in the market, which is yet to show up. So the good is economy, in my view, the global economy is going to be okay. The bad is it's going to be tough to get big returns. And the ugly is kind of a little bit the way you have to trade it, the way you have to play it. It's kind of like winning ugly. And I think it's going to require you to be a lot more tactical. The good news about the Fed tightening, in my view, and we'll talk about that as well, is that I do think that you're going to have more volatility. And of course, some people are trying to avoid volatility like the plague, but by the same token, volatility, I think, creates opportunity for professional money managers. It creates mispricings. It creates misallocations of capital. And hopefully, I think a more normal interest rate environment would give you some opportunities to take advantage of that. So anyway, that's the kind of a broad overview of kind of what I'm going to be talking about. As far as the U.S. economy is concerned, you could say, well, how do you feel? Why do you feel so confident that the U.S. isn't going to go into recession? And I think that's a question I get a lot, especially from people that cover the industrial sectors. I was just in Texas for 3 days earlier this week. I've never seen a kind of a quicker reversal of fortune in 18 months. Whereas 18 months ago, people were so bullish they couldn't see straight. And now, obviously, with oil prices where they are, there's been a big, at least in the energy patch, and Texas is it's a much more diverse economy than people give it credit for. But in the energy patch, people are pretty, as you might suspect, pretty pessimistic. And frankly, I don't know if I think people are more pessimistic on energy in Texas than any other place I've seen in the world, which it may give you some sense that maybe it's time to go the other way. But in any event, people are very worried about the possibility of a recession because of what's happening in the industrial world. If you remember from your economics textbooks, the GDP equation, which is consumption plus investment plus government spending plus net exports, and you kind of remember we're kind of roughly where they are. Consumption is about 69% of U.S. GDP, nominal GDP. Government spending is about 18. Housing is about 3.5. You lose about 3 from exports, and you have investment of about 13. The simple point is that about 90% of the GDP equation, particularly if you take a look at consumption and government spending, I would argue will grow next year. And we have a fair degree of confidence in that. Government spending in particular, I mean, barring this, with this latest immigration problem notwithstanding, if there is a budget deal, if the budget deal that was signed in the Senate a couple weeks ago holds, you're likely looking at least a 0.5 percentage point of GDP greater than you've had in the last year or two, just on government spending alone. And I don't have to remind you, next year is an election year, and a lot of state and local governments have surpluses. In election years, surpluses don't stay surpluses for too long. And also government spending, you're kind of lapping the sequestration, all the other things that the mess that came out of the last fiscal deal. So government spending it's going to go from being a headwind to being a tailwind in the next, in my view, in the next year to two. The next point would really be consumption. And I think this is another place where people are struggling. And they're struggling because for every decent piece of news you get on consumer spending, you'll get a bad piece of news. Or if you look at, let's say, Macy's earnings last week, I think they were last week, people say, oh my goodness, things are changing. The problem, I would say, for economists, the problem that we're having largely is that people are spending in such a different way that it's pretty hard to measure appropriately the dynamic changes that are going on. And it appears, particularly when it comes to millennials, when it comes to younger people, it's very clear that people are spending more on experiences rather than goods. So the aggregate spending is largely the same, if not greater. It's just that there's a very big mix shift that's going on in terms of where people are spending and how they're spending. One example of this, I would argue, is Walmart. You just take a look at Walmart versus Amazon. Something very interesting happened 3 weeks ago. Amazon actually now has a higher market cap than Walmart. Amazon has 150,000 employees. Walmart has 2.2 million employees worldwide, 1.4 million in the United States. So there are clear things that are going on that are changing the landscape of how people are employed, how they're making their money. We'll talk about that's part of the reason why people don't feel so great, despite the fact that the unemployment rate is low. But the simple point I would make is that consumption, it's very difficult by any econometric model you use to come up with a recession after a period in which oil prices have fallen $60 or 60%. It's never happened. Certainly not happened without other policy errors that would compound it. I would say the good news about Washington at this point is they can't even do errors. They can't do anything, right? So they can't do anything good, but they can't, I would say it's very unlikely they're going to do anything bad either, at least for the next year or so. As far as China is concerned, and we'll keep everybody on time. As far as China is concerned, the problem I have when I talk to people about China is that, and I talk to a fair amount of people like this, they say, well, they're all commies, and I don't believe anything they say. And so we do all these econometric models, and we do all this stuff, and they say, I don't believe any of it. And I say, well, you have to use something. You have to use some numbers. I'll say first, the econometric models we use tell us that GDP next year should be somewhere between 6 and 7%. And again, you could say, oh, that's a bunch of hooey. That's not going to happen. It's slowing down. Then I'll go to a more conceptual argument, which is to say that China, in my view as an economy, is based mostly on social stability. That is the primary, really, goal of the Chinese economy, in my view, is to keep people employed and kind of happy. And when you have $3.5 trillion in currency reserves, which China has, and now it looks like it's going to be part of the SDR, the IMF, I'd say they have a lot of flexibility. If they want to make growth 6 to 7, they could do that. Now, it might require them doing dopey things with the money, right? You know, building another Jersey City every 6 months or something that no one lives in, right? I mean, so, but at least for the time being, I'm not saying it's a good economic plan or a good strategy, but I guess my opinion is that especially with China, China also benefits greatly from lower commodity prices because so many people live at a subsistence level. It's very, very hard to bet on a hard landing in China, given their foreign currency reserves, given the model of the economy, and given the fact, again, that commodity prices have fallen quite a bit. The good news about the first two points I would make is that it can happen, but it's very rare that you have bear markets in the absence of recession. Almost all bear markets are associated with recession. There are exceptions, but the last one we had was 1987. And in 1987, believe it or not, from point to point, the market was up about 3% that year. As we know, we had one day in which it was down 22%, the S&P 500, but that was in a period in which interest rates went from 7 to 10. 10-year treasuries went from 7 to 10 that year, while the market went up 30. So this is a very different, I would argue, this is a very, very different environment. I would say, again, it's hard to get a bear market out of this, mainly because of this theme that we've been using. There are so few, it's a TINA market, which is to say if you're managing large pools of money, there is no alternative. It's very difficult. If you're a pension endowment foundation, you have to get an actuarial assumption of 7.5 or 8. It's just hard to do that when 10-year treasuries are 2.25, or German 10-years are 50 or 60 basis points. I'm sure somebody here knows better than I do. But listen, equities wind up being kind of the default asset class, and I don't think that's going to change anytime soon. Then there's a question of, if everything's so great, hotshot, why does everyone feel so bad? Why aren't people more optimistic? And it is an interesting question because if you were just to kind of look at it, very dispassionately, you say, well, the unemployment rate in the United States is 5%. The unemployment claims, the number of people signing up for unemployment insurance, is at 40-year lows. Hasn't been this low since the 70s, despite the fact that the labor force has grown dramatically. The S&P 500 is within a couple percentage points of being at an all-time high. Corporate profits are a little bit weaker, but that's almost entirely because of energy, which I would say there are positive offsets to lower energy profits, right? Which is the fact that a lot of us who are not in the energy space tend to benefit from it. And so you say, why aren't people happier about what's going on? Now, and I think it has a lot to do with a thing that people are talking a lot about, and I'm going to get into kind of some social and political discussions here for a minute or two, but it has a lot to do, in my view, with the hollowing out of the middle class and income inequality. The point that I might add, though, is that I feel very strongly that income inequality is not the result of capitalism, but it's the result of very bad policies that are getting in the way of capitalism. It's my own view. I don't want to offend anybody here, but if you want to take one policy in particular, I would take monetary policy. The Fed's balance sheet before Bear Stearns failed was $850 billion. It's now $4.5 trillion. The Fed's quintupled the size of the balance sheet. Say, well, the good news is more people are employed. The bad news is that if you look at the government data, corporate profits as a percentage of GDP are at all-time highs, and labor share of corporate GDP is at all-time lows. You could make a very strong case that in many ways government policies have exacerbated the income gap rather than narrowed it. My own particular feeling is that has a lot to do with the regulatory environment that we're in, which is to say if the federal government is suing J.P. Morgan for things that Bear Stearns did 7 or 8 years ago, it's not too surprising that banks aren't too enthusiastic about making loans, right? That in many ways, I think the monetary policy accommodation that you have is being sterilized by regulatory policy tightness. And then there is no fiscal policy to speak of, sadly. There's certainly nothing good coming out of fiscal policy. Trade policy is okay, I'd say. But in any event, this is, I think, part of the reason why people don't feel so great. I used that Amazon Walmart story before. You could extrapolate that. We've done some work where we take a look at enterprise value to number of employees. And here again, you find a very similar situation where you find that a lot of the wealth that's being created is being created in companies that have very few employees. So if you take a look at Facebook, Facebook has an enterprise value of about $275 billion, has 9,000 employees. Netflix, I'm getting this wrong, it might have an enterprise value of about $50 billion. It has 2,400 employees. If you go to the other side of the ledger, you take a look at something like Best Buy. Best Buy has an enterprise value of $13 billion and 125,000 employees. And so this gets into the question of, can you have a vibrant middle class without smokestack type industries or without a manufacturing base? And I'm trying to be somewhat provocative here, and we could debate that. But this is part of the reason, one of the big things that's facing the U.S. in my view. It's one of the things that's part of the reason, if you ask me why Trump is very popular. If you look at the Wall Street Journal had a great op-ed yesterday, if you didn't see it, about blue-collar workers, older white men in their 50s and 60s who largely have been displaced in the service-oriented economy. I think that's a big part of what's happening. So in any event, those are some thoughts. And I would say there's three. And then the last thing is say, well, how do you play it? Give me some ideas, investment ideas, and I'll give you three of them, and I'll take questions if you guys have any. The first thing I would argue, one place is exciting to me, I do think, is financials. I think, and that's simply because, given my outlook of the world, I think the yield curve is likely to steepen. And mercifully, I think a lot of the worst of Dodd-Frank in terms of the regulatory overhang is probably, it's probably behind us. But there's a lot of room for banks to make more loans. The average mortgage that was written in August had a FICO score of 760. Okay, so banks are largely just making loans to people they know can pay it back. And in my view, there's a lot of room, especially if the yield curve steepens, for banks to make a lot more loans. So financials, I think, and they're going to get a boost from modest Fed tightening, in my estimation. So that's one place I would look at. I like Japan quite a bit, and this is one of the things you learn when you do economics and investments. You have to learn that when you're talking about investments, everything is at the margin. It's not good or bad. Is it better or is it worse? And sometimes it takes a while to learn as you get older that some of the biggest money is made when things go from horrible to merely bad, right? That things going from pretty good to good, or it's okay, or good to great, is less so. But you really make big money when things go from horrible to merely bad. Japan, as far as its relationship with minority shareholders and its focus on return on equity, is something that is going from horrible to merely bad, which is to say that these are companies that have a lot of cash on the balance sheet. They've ignored their shareholders largely, not the big blocks of stock, but the average people. They're focused more on dividends. They're focused more on buying back stock. Those companies are trading at pretty cheap levels, and the earnings growth is pretty good. Dividend yield is about half. Dividend payout ratio, is about half. It is in Japan is what it is in Europe. The last thing I would mention just simply is that I think the M&A boom is going to continue. And I think there's a lot of people who are looking at the M&A boom and saying, gee, it's got to be close to being over, because you're seeing some kind of dopey deals and all the rest of it. And I would say, just based on my experience, rationality doesn't end M&A booms. What ends M&A booms, generally speaking, is a drying up of the raw materials that create it. It's like a fire. And the raw materials are largely created of cheap financing. And if financing stays cheap, I think you'll be surprised at the amount of deals and how creative investment bankers will get in terms of what they're what they're going to try to do, especially in a world in which you're not in recession, but you have slower growth. There's going to be a very strong tendency to try to grow through acquisition. I think that's going to continue. In any event, that's 23 minutes, 24 minutes. There's an awful lot there, I guess. But I don't know if anyone has any questions, but I'd be happy to answer them if you do. Yes, sir. We'll start all the way in the back.
Monetary policy, where are your dots?
Well, yeah, where are my dots? Well, listen, let's say this. I think I don't have dots, but I'll tell you what I think is going to happen. I think the Fed goes in December for the first time. That's maybe, it's a little better than a toss-up. I think they maybe go another time or two in 2016. But it would be very hard for me to see short rates at anything more than 50 to 75 basis points a year from now. And I think, so there's obviously next year being an election year, the closer you get to the election, the less interested the Fed is going to want to be in getting involved. And I would say the good news, the Fed has a lot of flexibility because inflation is low. There's also a feeling or, a school of thought, which I'm sympathetic to, and I think the Fed is starting to become sympathetic to, that lower interest rates in many ways might be harming economic growth, which is to say that, especially when you think about it from a company's point of view, if the cost of capital is so low that you can merely issue debt and buy back stock instead of doing CapEx, that's what most companies are going to do. And that's what's been happening. And so, anyway, it's a long-winded answer to your question. I think the Fed tightens, but I also feel very strongly Janet Yellen is not a hawk. I think she's as dovish as advertised, and I think she's going to be very, very, very modest in her attempts to tighten monetary conditions. Yeah, I'll miss, yeah.
You mentioned the possibility of increased government spending at various levels. What about issues like what's going on right now in Chicago, where there are major problems with pension and other employee benefit liabilities?
Yeah, listen, I think the Chicago, I think, is a special case. I mean, and I'm not sure it's enough, I know it's not enough kind of in a macro sense to kind of derail what I'm talking about. The good news, I would argue, is that 49 of the 50 states have balanced budget amendments. So you're limited with the amount of rope you're given to hang yourself, although you can invent ways to hang yourself through creative accounting. At the state and local level, just like you can in business. Chicago, I think, is an extremely interesting case. I'm not sure it can be extrapolated to the entire country. I will say this, though: I think a lot of state pension funds have too much exposure to alternatives, particularly private equity, and I think a lot of the actuarial assumptions that you see at the state and local level or state pension fund level are based on very, very aggressive estimates of what private equity is going to return. And that's something you might not realize for a long time. That's kind of the beauty of private equity in some ways. It's the opacity of the product. But to me, that's a longer term, I would say, I don't think it's a 2016 issue, but it could be more of an issue 5 to 8 years from now. So, yes, Miss.
I recently read an article says that the baby boomers portfolio, they are heavily focused on the stock right now, but they're supposed to be at that age appropriate where we need the fixed income. So when the Fed raise interest rates, they're supposed to de-risk the portfolio and move to the fixed income side. When that happens, it will flatten the yield curve.
Yeah. Listen, I read that article by, I think it was by Michael Thompson in the Journal the other day. And the question is, baby boomers aren't baby boomers overexposed to equities, and shouldn't they be moving to fixed income? And once they do that, shouldn't that flatten the yield curve? I can tell you, I read that article, and I've done a lot of work on this. I want to figure out where he's getting his data from, because all of the things I look at, if I add up mutual funds and ETFs together, there's actually been net redemptions from domestic equities over the past 7 years. And there's been an enormous inflow into bond funds, particularly out of money market funds. So I guess, and I don't mean to be rude, I just kind of reject the premise of the question, just to the extent to which the data I'm looking at tell me that people have too much exposure to bonds and bond funds, particularly as a proxy for cash. And, you know, it's one thing to have exposure to bond funds if you realize that you can lose money. But I'm not entirely certain a lot of people realize that. And the last time you had a taper tantrum, you saw a lot of redemptions out of bond funds very quickly, 3 or 4 months, and then, you know, it's worked out. But if interest rates were to ever back up, I think that would be a big problem for the individual investor. This is also something I would say, the Fed is essentially, you know, driving people to take more risk, right? By certainly savers, right? I don't know how much time we have, but I'll give you one story though, right? That or a guy, Pat Toomey, you may know, as senator. Pat Toomey worked in this business. He was, I think he was a derivatives guy at Deutsche Bank, but he's a very bright guy, very, very up to speed on these issues. And he was, during the Humphrey Hawkins, I don't really call it that anymore, but during a period in which Ben Bernanke was in front of him, he said to Ben Bernanke, he said, listen, what do you tell a constituent in my district, talking about low interest rates, what do you say to a constituent in my district that bought a house with 20% or 25% down, doesn't take the kids to Disney World, takes the kids to Hershey Park, you know, works hard, saves money. What do you tell that person about your policies? And I don't mean to pile on Ben Bernanke, but he simply said, she's got to take more risk. That was the answer. And that's a little bit what QE, you know, is the focus of QE, is getting people to take more risk. The problem, in my view, again, is that I think it's forcing people to take more financial risks rather than economic risks. So people use that to actually start a business or build a new plant or something and say, that's good. But if it's resulting in people reaching for some sort of extra yield somehow, could be a misallocation of capital. But if there are any other questions, yes? Hopes for wage growth. So this is another, I mean, this gets into what we were talking about before, and this is part of the reason why people feel kind of crummy. If you look at, let's say, average hourly earnings are they're up less than 2% year over year. And again, you are seeing a pretty big bifurcation, really largely along educational lines. You look at people that are, if you can do this, people that are educated, have higher education, their unemployment rates are significantly lower, and their wage ability to get higher wages is much greater. If you kind of go down the scale and you go down to, let's say, people that don't have a high school education, as you might suspect, the unemployment rate is significantly higher, the participation rate is significantly lower, and the bid for their services isn't really there. So I guess what I would argue is that I'm not particularly worried about wage inflation, mainly because, and maybe we should be more worried about that it's not high enough, as opposed to the fact that it's too high. But this is something where the disruptive technologies that we're talking about, Amazon versus Walmart, are having a big impact. So I don't know if there are any other questions, but yes, Ms.
In this new age of abundance, a lot of economists think it's like change now and enjoy it. But with technology, with innovations, the supply is greater, but that doesn't mean the demands are raising, and less jobs. There's M&A activities, less, more competition, competition, again, less economy. So this is the technology disruption and the abundance is not the outcome, it's the cause for
Well-
the rich get richer, the poor get poorer.
Well, you know, and
How do you, as a policy, let's say, advisor,
yeah.
how do we basically get some of these abundance dividends to those who are
Well,
really still suffering?
I would argue, and this is, again, I don't want to,
It's a cost, it's not really.
well, no, I think, you know, my own view, again, is I guess I have a difference of opinion, which is to say that what I think the social engineering aspects of what we're trying to do are actually hindering, I got to stop here.
Repeat the question.
Oh, so the question is, isn't technology what's creating the problems as opposed to solving them? And I would say there's always been technological innovation. We had in the late 19th century, you had consistently lower inflation. You had a massive deflation because of a productivity boom, and people found other places to work. So, you know, the buggy whip manufacturer eventually turned into something else, you know, that actually made sense. And so I guess I get worried when there's a cult of PhD in the US government right now, in Washington, which thinks that, and particularly I think at the Fed, they really believe themselves as alchemists, that if they, you know, put enough of beaker A into beaker C, that it'll create something that they want. And I would argue that until I'm proven otherwise, it's not perfect. I think the best allocator of capital are free markets. And I feel very strongly that it would be a bad idea to try to change that. I'll say this, too. I am also very sympathetic to the idea that the way trade is being conducted now, particularly as it relates to China, is not free trade. I mean, if one currency is pegging its currency to another currency, that's prima facie not free trade. So there are a lot of, I would argue it's kind of people getting in the way of letting the markets work as opposed to letting them work on their own. That's creating a lot of the problems. But again, that's my little Larry Kudlow speech there. So, I'm probably ready to get the hook now. I think that's it, guys. But I'm happy. I'm going to be walking out right now if anyone wants to chat. But thank you very much for your time today. I appreciate it.